Good morning. Welcome to Trading Hour. I'm Reema Tenduka. With me is Hormuz Fatakia, and it's 24,300 on the Nifty, 1.25% higher. It's a good start, right? Yesterday also we had a gap up opening, but that rally didn't sustain. At least so far in the first 2 hours of trading, markets have held on to all their gains. In fact, if anything, even built a little bit on it. So right now, if you pull up the tally on the ticker, it's 300 points in the Nifty. The Sensex is up close to about 850 points. And the risk on in the global markets, or the rebound in the global markets, also sustains. So the Taiwanese markets are up 3.5%. Nikkei is up close to about 3%. So there is that global rebound, and statements from Bank of Japan that they will not raise interest rates further if the market is unstable has also stabilized the global market. So back home, if you have to look at the winners, Midcaps for one are outperforming. The Midcap index is up 1.9%. Pretty strong advanced decline ratio to begin trade with. You've got PSUs, which are shining bright. The Nifty CPSE index with a gain of more than 3%. So ONGC, Coal India, BPCL, top honors. In that, it's the oil and gas basket. That's up close to about 3%. Again, we'll discuss ONGC in greater detail, but so many other metals sectors are participating. So whether it's metals, whether it's auto, realty, all these stocks and sectors are higher today.
The question is whether this will sustain.
So far, it's sustaining.
So far, it's sustaining. And as always is the second half of trade when the indices started to cool off. Even yesterday's trading session, now 24,300 on the Nifty, as Reema was just mentioning. There's one sector, though, within the PSU basket that has had some extremely choppy moves in today's trading session, and that is the shipbuilding stocks. And those shipbuilders, be it Mazagon Dock, Cochin Shipyard or Garden Reach, all three of them have had extremely choppy moves all through the day. Mazagon Dock at one point was in the negative. Now it's trading with gains of close to 4%. Even that rise has gotten sold into slightly. Garden Reach 2 at one point was in a lower circuit of 5%. Now it's trading with gains of over 1.5%. And all of these three names have corrected almost 30% from their peaks, and yet they are trading well above their 5-year historical price to earnings multiple. So that is one sector you keep an eye out for. Of course, the bigger laggard, though, in today's session is the Nifty Bank, and that has been the main pressure point on the Nifty, even it be in yesterday's session or today as well. Slightly off the lows of the day, but still 0.5% higher, still struggling to hold on to those levels of 50,000 on the upside. And it's also the weekly expiry for the Nifty Bank, so that will keep the index in focus as well. Pull up one particular stock that I wanted to highlight, though, was Fusion Microfinance. And that stock is an earnings reaction, 20% lower circuit now for the stock. Credit costs were elevated. Asset quality saw very significant deterioration. We'll speak about this more on the show. But 346 on the stock now. After this 20% lower circuit, the stock is below its IPO price. Okay,
we'll discuss that in greater details. There's also a JM Financial downgrade on Fusion Microfinance. And I think for them, the credit cost ballooned up to 11%, much higher than the 3% guidance that they laid out for the full year. But again, we'll discuss this stock in greater detail. For now, let's invite Unmesh Sharma from HDFC Securities on the show now to discuss the way forward. Unmesh, it's been all over the place. It's all happening this week, right? First, the slam dunk on Monday, then the tentative pullback yesterday, and today you are seeing some bit of green holding on to our markets. What's been the conversation with you and your clients? What are you telling them?
So, look, the markets were in a valuation range, which we all knew that, at some point in time, there is going to be some kind of action against this. When, 1 out of 10 stocks is trading at 100 times earnings, this is the type of thing which happens. Having said that, look, how do we play this, right? What we do know is in the very short term, which is like today, what we are waiting for, which is to see what happens with the European markets. And we know in the long term, the numbers are fine, and that if you see even earnings season is coming through, it's kind of stable, so you know who is performing, who's not performing. The problem is actually in the intermediate term, and which is where the question is as to what is the surprise that can hit the markets. Honestly, and it's not even the US elections or something. I think the question that everyone is asking is where will the estimates for the rates settle, and which is really what has led to violent moves in the market. And it feels like, slowly there is some, there was probably a little bit too much panic in the last couple of days, because at one point in time, the CME Fed Watch was saying that there is going to be a 50 BIP rate cut in September. There was also probability being built about the fact that there would be an emergency meeting of the Fed and a rate cut would happen. I don't think that either of these are going to play out. So I think settle what will happen is that volatility will come down. But at the same point in time, given where valuations are, we could see a sustained period of time where the markets may actually do nothing.
A sustained period of time when the markets would do nothing. Do you believe, Unmesh, that this cautious stance that the market is taking is also because of the RBI policy that is in line tomorrow, because of what the MPC is likely to say? Now, until last week, it was most probably a status quo policy, but considering the turn of events that you've had over the last 4 or 5 days, the street is also on the edge as to what the MPC would have to say with regards to its stance and all that. Would you believe that this cautious stance is also because of this, and it might eventually catch up with the valuations as well?
Yeah, so partly true. I think what is happening is that okay, so the market kind of, once the broader market expectations on the Fed became that there's going to be a 50 bp rate cut. Obviously, one of the things which started to come about is whether whether RBI will preempt all this and do something similar. See, our strong view is that that is not going to happen. Because one is that they will not preempt what, try to second guess what the Fed is going to do. The second is that the scale of the problem in the US is very different from what it is in India. So, we continue to believe that status quo is the main, remains the stance. The only nuance that our economists have added is the fact that there is a possibility that instead of withdrawal of accommodation, that we might move to a neutral stance on the liquidity front. Now, that cannot be seen as a negative. So if you put that into context, what will happen is that the RBI policy is unlikely to scare anyone. What may happen, however, is that the statement, and especially when the MPC minutes come out, there would be statements made that they are closely watching what's happening in the United States and global markets. And that could concern a few people. But broadly, I don't think that, yes, there could have been panic because of that, but I'm not expecting anything to move on that front at all.
Okay. Based on the earnings season so far, have you made any changes to your model portfolio?
So about 140 of the stocks under our coverage out of 230 odd I've reported. So far, see, we don't make changes to model portfolio basis, only half the data. What has happened, however, is that earnings broadly, if you take a cumulative of all this, it's obviously, we'll see how things play out later, but as of right now have missed by around 1%. And there has been very small marginal 0.5 to 1% kind of cut if you look at it on aggregate. But what has stood out very clearly is that autos driven by Tata Motors to a large extent. Pharma has done well. Large banks have done okay. Insurance companies have done okay. If you look at earnings, generally there have been not too many positive or negative surprises, but on aggregate, it's been muted, So what is happening is that if you net off oil and gas, because there's been a fall there because of oil prices, but if you net that off, we are in the low teens as far as earnings growth is concerned. That's what we expect for the rest of the year, adjusted for oil and gas. And I think on that, if you look at where valuations are, broadly not expecting anything very exciting to come out of the earnings season going forward as well. So we'll wait and watch before we look at our portfolio again.
So no stock-specific changes so far?
No, not yet. Not yet.
Not yet.
We will do that, accumulated once we have all the evidence in place, which is likely to be, once the earnings season is over.
Sure.
Would you do some tinkering with the banks in your portfolio, Unmesh? Because you mentioned banks have done okay this quarter, but then, of course, there are these concerns of slowing deposit growths, of deposits getting withdrawn from the banks, and adding to that is the pain in the rural economy. You've seen a lot of microfinance companies reporting stress in their portfolio. Does this entire BFSI segment now warrant a lot more caution, particularly because it has been an underperformer to begin with? The Nifty Bank has not done it, has been underperforming the index even on its run towards 25,000. So what do you do with these large private banks, or even PSU banks for that matter, and couple that your views with the MFI space as well?
Yeah, so look, our stance on this one for a few months has been now, not necessarily everything has played out, and maybe now it will, is that, the valuation comfort on the large banks was better. The concerns on the concerns on the deposit side were there. We had thought that there would be some correction, and that has not happened as yet. But at the same point in time, there is one thing that we need to really watch closely, is that other than the warning that was given by the Reserve Bank governor on, unsecured credit and whatever we are seeing in the rural, there has been actually, we are at the peak of the rate cycle, and honestly, nothing has really blown up, touch wood. So if you look at it from that perspective, going forward, while for 6 months we've had this stance, and that may not have played out exactly, but broadly where we are positioned right now is that, that we do not expect things to get worse on the rural given, how the monsoon is progressing. Of course, there are pockets which are not good, but broadly given how the monsoon is and, the focus of the government on supporting bottom of the pyramid consumption. And on top of that, the large banks still provide comfort. And, we continue to remain positive on the strong deposit franchises. So if you look at our model portfolio, things like large banks like ICICI, Axis, and on the PSUs, SBI, and, in the rural, we have ours in there. So it may not have played out beautifully so far, but I think that is not something that needs to change now because the core assumptions remain in place. So that's where we are.
Ulmesh, thank you very much for joining us this morning. We need to get into a short break. We'll come back and talk commodities with Manisha Gupta. Stay tuned.
Back with us here on Trading Hour and onto the commodity space now. Manisha Gupta is joining in. We're focusing on crude oil today. Manisha, good morning. And suddenly, from being on the boil, oil is suddenly on a slippery slope now.
It is, yes, it is. We did see a 7-month lows come in for the crude oil prices. And at one point in time, you really thought that the prices will break below 70 as well. Did not happen. And we've seen some buying opportunity come in on your screens. As you can see, 0.5% of a gain. And this is the second straight day that we have seen the crude oil prices trying to see some opportunity buying from the lower side there. Well, there was a very strong Goldman Sachs report after that meltdown that we saw across asset classes suggesting that the Brent prices will not fall below 75, and that's a strong support. We did see Brent go to 74, but it's holding around 76.5 at this point in time. So 75 seems to be the pivot point right now. The other thing is that the US crude inventories have increased in the last week, and this is after 5 weeks of constant decline. But even with that, the EIA says that if you look at the global inventory, there has been a deficit of 400,000 barrels in the first half, and that is expected to increase to 800,000 in the second half. So we are working with a global deficit scenario here. Also, the EIA says that when you look at the US, oil demand for the month of May, it did hit a record highs. But since then, we have seen prices or the markets not do so well. For the Indian demand for the month of July, we saw 4% of an increase on an year-on-year basis across various levels here. So when you look at within the Asian markets, China may not be doing so well, but India definitely seems to be looking seems to be looking at some positive points there. So the expectation going forward that the crude oil prices perhaps are done with a near-term correction.
Okay, but it doesn't look like the Indian markets are done with not a correction, but in the last 15 minutes or so, we've seen the market slip a bit. We opened with the Nifty at 24,300, and now we're at 24,230, about 70 points being taken off in the last 10-15 minutes. Get into a break. We'll come back and discuss market technicals with Mitesh Thakkar. Welcome back. Let's get to the big movers of the day. And top of the charts, busting them actually is ONGC, 7% higher on the back of the Q1 numbers and brokerage commentary, management commentary. Sonal joins in with more details. Sonal.
Thank you for that. Well, it was a good set reported by the company, and in their conference call yesterday as well, they sounded quite positive, maintained most of their production guidance as well. On the back of this, brokerages are positive now. Jefferies has written a note where they have a buy rating. They say management reiterated their production ramp-up outlook for KG Basin, which is third quarter onwards, and that is something that makes them positive on the stock. They will achieve peak production in both crude, which will be 45,000 barrels per day, and for gas by 10 MMSCMD, which will be there by end of FY25. They expect KG production to contribute 11% to the consolidated EBITDA coming in from FY26. The premium pricing, which the government is under discussions as well for new wells, that is something that should benefit 14% of their volumes and EBITDA as well. That's why they've increased the target price to 410 versus 390, which is of course a rollover as well. But nevertheless, it's higher on the back of positive commentary. Nuvama says management is of the view the levy of windfall taxes on crude produced at KG Basin is unlikely. So far, they've not been paying any taxes. There was a fear that there could be windfall taxes there, and that is something which could be negative, but that is not the case right now. However, they maintain a reduce on the stock with a target price of 245 rupees a share. Prabhudas Leeladhar, they say combined current gas production from two clusters of KG Basin is 1.6 MMSCMD. The target is to reach 6 MMSCMD by FY25, at the end of FY25 that is. And on the back of this, they have upgraded the rating from reduced to a hold with a target price of 322 rupees a share. So positive brokerage and management commentary is something that the street is liking.
Okay, what about Oil India? That's also up close to about 8%. What's happening?
Well, you know, Oil India reports numbers tomorrow. It has been a big outperformer anyway this year. But some points that we'll be watching out for in the numbers this time around, the production guidance. Across these E&P names, we are looking at production increase, and that is something that the government has been focusing on as well. The update on progress of Numaligarh refinery capacity expansion, because that will aid GRMs and then ultimately the EBITDA in their consolidated numbers. The increase in production at the Bhagjan field is also something that we'll be watching out for closely. As I said, stock has been an outperformer this year. It's up 146% year to date. And on the back of this, valuations, they are also at a premium versus ONGC. So Oil India is trading at 9.4 times FY26 EPS, while ONGC is trading at 5 times. So that is the valuation differential, but still Oil India continues to move higher.
It's showing there best calendar year in at least many years for Oil India. Sonal, thanks a lot for both ONGC and Oil India. Over to Sudarshan now. He's joining in with an update from TVS Motors. Numbers came in yesterday during market hours, but some very positive commentary coming in from the management in the earnings call, Sudarshan.
That's correct. So TVS Motors is today one of the top mid-cap gainers and is sharply higher. And if I can talk about the reasons, company reported earnings during the market hours yesterday, and those earnings were in line but sharply higher year on year, and margin came at a multi-quarter high of 11.5%. Revenue increased 16% and EBITDA was up 22% year on year. But more than earnings, what market is factoring in is the commentary that came from con call, which happened post-market yesterday. Company expects robust growth in Q2 due to normal monsoon and improving economic environment. On the capex front, company has increased FY25 capex. It's now seen in the range of 1,000 crore to 1,100 crore versus up to rupees 1,000 crore earlier. And on the margin, company says current level of margin is sustainable in the near future. Some of the other comments were material cost reduction is expected to be sustainable, and commodity price increase was offset by material cost reduction, and if needed, company is ready to take the price hike further. And post earnings and the commentary, most of the brokerages have maintained their positive stance and at the same time have increased target price. Jefferies has a buy call and increased target price to rupees 3,000 per share. It says company should be a key beneficiary of a two-wheeler demand revival, and improving franchise should also drive continued margin expansion. And over FY24-27, it expects EPS to more than double. Macquarie too maintains outperform call, and target is seen at rupees 2,783 per share on TVS Motor.
Thank you very much for that. Let's get to the pharmaceutical names then. Lupin gains on the back of the Q1 numbers. Ekta joins in. Ekta?
Well, yes, a very good set of numbers which came in for Lupin. Revenue was up around 16%. Street was anticipating only a single-digit growth this time round. Margins came in at multi-quarter highs at around 22.2%. Estimates were around 19 to 20% and a profit of around 800 crores. Now, what really led the markets, led the numbers higher was the US sales, which was at around $227 million versus estimates of around $220 million and versus $209 million that they did in the previous quarter. India also did well. It's around 35% of their total business. It was up 17.5% year on year and up around 20.3% on a Q-on-Q basis. There was a double-digit growth which came in India after multiple quarters of being sluggish. Now, the company says that they are on track for a sustainable, strong growth and improved margins. Nomura has a buy target price of 1952. They say that the company now has a net cash, and that is a positive. Macquarie has an outperform target price of 1785. Q1 was an all-round beat according to them.
Back above the mark of 2,000 now is Lupin, 5% higher, near the highest point of the day. While Lupin had a very good quarter, what did not have a very good quarter is Gland Pharma. Ekta, take us through that as well.
Well, yes, tough quarter for Gland Pharma. Revenue was up 16%, but the street was anticipating over around a 25% growth this time. Margins were the key disappointment, came in at multi-quarter lows of around 19% versus 24%, and profit of around 143 odd crores. The reported margins were impacted by their acquisition Sensex, which reported an EBITDA loss of around 28.6 crores this quarter. And as you can see, maybe in the margin chart, the margins have slipped below 20% also, and are the lowest that we've seen since Q4 of FY23 on a consolidated basis. US revenue was up around 27% year on year. India, however, was down 19% on a year-on-year basis. Now, the thing is that the street was working with a higher growth. So, though they showcased double-digit growth this time on a year-on-year basis, the street was anticipating more of a Q4 run rate. They have indicated that they continue to see strong demand in the US. They have guidance for mid-teen growth also, but overall, the next quarter could be impacted because of plant shutdowns, so the street is factoring that in. They've reiterated their guidance of an EBITDA break-even in Q4, plus profitability in FY26 for Sensex. Elara has downgraded the stock to reduce. Nomura has downgraded the stock to reduce as well, and Citi has a sell on the stock.
Thank you very much for that. But it's off from the early morning lows. When it opened, Gland Pharma was down close to about 8%. Get into a break. We'll come back and discuss market technicals as promised with Mitesh Thakkar.
The government is currently mulling over these representations that it has received on the budget proposal.
The old tax regime continues to coexist with the new tax regime, given the option to consumers, to taxpayers, to switch depending on what they feel they most prefer.
Amendment was moved in Parliament, and essentially what it does is that it gives people, like the current tax regime, the option to either avail of the indexation benefits or avail of the lower rate of tax indexation benefits wherever the option is the lower.
Welcome back. Midcaps continue to outperform. The midcap index is up 1.8%. There are some stocks which stand out. One of them is Crude Brands, the manufacturer and retailer of Mufti, Mufti brands. That stock is up 15% on pretty large volumes, reacting to their Q1 number. And here, I think it's the recovery in the same-store sales growth. So last year, same-store sales growth was anemic at just 0.6%. But in the current quarter, same-store sales growth has gone up by 2.9%. So there is that pickup which is boosting Crude Brands on the back of their Q1 numbers. TPZ came out with their numbers yesterday, and that stock is up close to about 13%. Again, a 50% jump in the company's profitability. Indraprastha Medical. Not Indraprastha Gas, but Indraprastha Medical. Pull up a one-week chart, and it's the second consecutive day of gains over here. And in the textile makers, it's a mixed picture. While Kitex Garments continues to gain up close to about 6.5%, you are seeing profit booking in KPR Mills and Gokuldas Exports. And keep your eye on Samhi Hotels, 3.5% up move, again, reacting to their Q1 numbers. Good set of results coming in from Samhi Hotels. But let's invite Mitesh now back on the show. Mitesh, in the green, 1% up, but again, not still at the morning highs. Your thoughts on the day so far and your stock calls?
So, I was talking about a possibility of a pullback purely because of the fact that, the PCR was extremely oversold. That has played out, but this reversal doesn't, look very convincing. So while there could be still some more upside, and as I said, I think the first resistance is about 24,350, and we got a high of 24,338, and then 24,500. So I think, unless it will be clear these levels, it will be a sell on rallies market. So on the index, buy some put options around 24,300, 350 zones, and add maybe in the future side short if it gets closer to about 24,500. Take a 100-point stop from there. I think good chance that eventually, after a couple of days of choppy activity, we might look at fresh lows. So slightly the views on the negative side. And on the stock calls, ICICI Bank, I think, despite the fact that the market is positive, this is a stock which is one of the first stocks to go into negative. So sell here. Keep a stop at about 1180. Look for targets of 1120 on the downside. Maybe, we can look at lower levels. And McDowell's United Spirits, that's a buy with a stop at 1440 for targets of 1500.
All right, Mitesh, thanks a lot for that, for your specific stocks and your views on the index as well. But moving on then, we just mentioned about Fusion Microfinance earlier in the show. The stock is under pressure after delivering a weak set of first quarter numbers. Vamakshi is here to give us the details. Vamakshi, tell us what went wrong.
Well, it's a weak set of numbers coming in for Fusion Microfinance. There is no pain as far as AUM and disbursements are concerned, but the NIMs have remained flat at 11.6% on a sequential basis. NII too is up nearly 35%, but the cost-to-income ratio has surged to 38.4%, up nearly 210 basis points YOY. The PPOP is seeing an uptick of almost 26.5%. But the main problem in the numbers is the asset quality that has seen a very sharp knock. The impairment of financial assets has risen both on a sequential as well as YOY basis to 348 crores, and resultantly the company has reported a net loss of 36 crores as compared to a net profit of 120 crores seen in the same quarter last year. The asset quality has deteriorated significantly. GNPA now stands at 5.46%, a deterioration of almost 260 basis points sequentially, and NNPA too stands at 1.25%, deteriorating by almost 65 basis points. We have a note coming in from Motilal Oswal. They've gone ahead and downgraded the stock to a neutral. They've revised their target price to 440 rupees per share. They believe that it was a weak quarter. Credit costs have shot through the roof for the company and stand at 13% on an annualized basis. They believe that the current sectoral stress may linger on for longer than most expectations, and during this period the credit costs could remain elevated. So given all of these factors, they've cut their FY25 and FY26 EPS estimates by 32% and 8% respectively, and they're estimating ROA to decline to 3.4% and ROE to slip to 14% in FY25. They see no upside catalyst, no respite in sight, and as a result, the stock is reeling under pressure today.
Thank you very much for that. I think the Fusion Microfinance credit cost guidance for this year was 3%. And this quarter, it's hit double digit. Look at that chart, just down 20%, absolutely no movement after that. We will slip into a very short break on that note. We'll come back and get you and tell you why stocks like Bata and PB Fintech are also buzzing in trade. Stay tuned.
Welcome back. Pull up Cummins India, and that stock has seen a sharp uptick towards the highs of the day, and that is because of the con call comments that are coming in from the management. There you can see 3.5% higher now at the highest point of the day. 36.50 is where the stock is currently, and the management in its earnings call has mentioned that it is expecting double-digit revenue growth to take place in FY25, and the street has taken that very well for the stock. Remember, it opened lower after its earnings, but now after the management commentary, it's trading towards the highest point of the day. Strong results driven by robust domestic demand. The export demand also is stable, and the demand continues to be strong for our products. Remember, they also mentioned that the power gen segment has now completely shifted to the CPCB4 emission norms, and that is something that the management has also highlighted. Now, they've also said they're close to 5,000 gensets for the CPCB norms were sold during the first quarter, and some positive management commentary. The stock taking it well, 3.5% higher on Cummins India. But moving on to some important opinion coming in from Chris Wood of Jefferies, and he's saying that the Bank of Japan will probably stay on hold as the Fed starts cutting interest rates, and he does not expect these two big central banks to move in opposite directions. Listen in.
Yeah, completely reactive, as you say. Unfortunately for the BOJ, the long overdue effort to normalize Japanese monetary policy, unfortunately for them, then coincided with the first comprehensively weak employment report. Everybody's been expecting the US labor market to weaken in recent months, myself included. It has been remarkably resilient, so it was bad luck for the BOJ that the US labor market finally showed clear evidence of weakening just after they normalized rates. So we've had this 1 week data point on the employment market, which has caused these monetary easing expectations to pick up dramatically, just like we had very aggressive monetary easing expectations at the start of this year. So the markets are assuming what I'm also assuming, that in a situation where the labor market really weakens in America, the Fed will prioritize employment over inflation. But obviously, that raises two issues. Will the labour market continue to weaken? That's my base case. But it also, next week, I mean, the inflation data next week has now become important precisely because the money markets are now discounting more aggressive easing. So if the inflation data goes the wrong way next week, that's going to be a negative for markets.
Okay, just want to highlight that Cummins is reiterating their double-digit revenue growth forecast for FY25. They'd spoken about it even when they released their Q4 numbers in the conference call, that for this year we're expecting a double-digit revenue growth, and that has been held on. Very strong numbers for the second consecutive quarter for Cummins India. But getting back to Chris Wood, we also quizzed him on the India outlook. And the question posed to him was that if you have $100 worth to invest in India, how much would you invest? Listen in to his views on India now.
India has shown remarkable resilience in the last week, or in fact, it's shown remarkable resilience in recent weeks and months. As for the Indian stock market, is being driven first and foremost by domestic flows. So what's interesting about India is foreigners are barely over. We don't believe foreigners are even overweight India anymore because of the big rise in the India's neutral weighting. We've had huge flows on the part of domestic mutual funds and retail investors into the Indian stock market. So the resilience on the capital gains tax is more surprising to me than on the election. And then we had the resilience demonstrated over this BOJ-triggered correction we've seen in recent days. However, I have to say that tactically I'm a bit cautious on India, but it has been extraordinarily resilient. So if I was investing, if I had a mandate to invest $100 in India right now today, actually I would only put in 1/3 of the amount because the overwhelming likelihood is we need to see a bit more of a correction. But fundamentally, India remains by far the best equity story in this region and globally on a 10-year view. And the fact that it's been driven by domestic money and not dependent on foreigners is extremely positive. It also means that any major correction in India, the foreigners will buy because they're underinvested in the market.
If there's any major correction, foreigners will be buyers, but as of now, there's been relentless selling from foreign institutions since the budget. But moving on, the other stock that is under pressure today is Bata, and that is after reporting its first quarter numbers. Mangalam is here to tell us more. Mangalam, how do the numbers look like?
Well, these numbers were soft and expectedly so because, consumer sentiment has already been weak and the first quarter was impacted by elections and heat wave that limited, store footfalls or all purchase decisions, so to say. But in that, the company saw an improvement in their gross margins, but higher employee costs and the investment that they made in tech, a one-time investment of nearly 15 crores, further impacted their EBITDA. On the bottom line, you'd see a 63% growth, but that would largely be led by an exceptional gain on sale of land to the tune of almost 134 odd crores. So just to run you through the numbers, 1.5% decline in the top line, close to 945 crores. Margins, the gross margins were maintained, but the EBITDA margins were impacted largely by higher employee expenses and the one-time 15 crore investment. At the same time, the company said they've added 33 franchise stores during the quarter, and they anticipate the festive season-driven consumption uptick to continue. And as a result of which, the stock, which was under pressure, has now come mildly off lows, still sitting with a cut of about 3.5%.
Thank you very much for that. Moving on to PB Fintech. Good numbers. Yash joins in with the latest. Yash.
Well, Rima, strong quarter for PB Fintech and the growth came from both sides of businesses, the core business as well as the new initiatives part of it. As far as the total business is concerned, revenue out of the total business grew by 52% in the quarter. Contribution, which is essentially your revenue minus the fixed cost, that grew by 29%. Contribution margin, that saw a little blip of about 500 basis points, but that is largely because the company has made significant investments in this particular quarter towards capacity addition, and that resulted in the contribution margins coming down. Adjusted EBITDA, that doubled in this particular quarter, came in at 49 crore versus 23 crore rupees. Adjusted EBITDA margin increased by 200 basis points. Now, as far as an important number is concerned, that is the revenue, the trail revenue, ARR, that came in at about 559 crore rupees versus 418 crore rupees. The management in the con call has indicated that this number is expected to grow even stronger in the second half itself of this financial year. If I have to sum up the numbers in three important sentences, it would be strong premium and revenue growth both in the core business and new initiatives, and with a growth of 112% premium and 132% in revenue in the new initiatives business. Now that business has become almost half of the core business. And finally, on one hand, when the core business, which entered the positive territory, is expanding its reach there, the new initiatives business is now starting to cut down its operational losses and move towards that positive territory.
Yash, thanks a lot for that. 4.5% higher now. PB Fintech is almost nearing levels of 1500. By the way, some more commentary coming in from Cummins in its con call, and it's mentioned that the exports as a segment has bottomed out and it grew sequentially due to the strong demand that it was seen in the African region. And they also say that because of the West Africa and green shoots are seen in the African business, so the stock has extended gains now. 4% higher is Cummins India. But the other stock on our radar today is PFC, and that is because brokerages like CLSA and Bernstein have both issued an outperform rating on the stock. Vamakshi is here to tell us more.
Well, PFC in focus on the back of a couple of brokerage notes. Let me first start off with the one that came in from CLSA. They've maintained an outperform call given a target price of 610 per share. They say that in the first quarter, the company reported an uptick of 24% in its net profit, which was 5% ahead of their estimates, and that was mainly on account of gains in Forex. Loan growth, however, was slow at almost 10%, but the management indicated that this should settle down soon, and FY25 growth guidance of 12 to 15% is still maintained. On asset quality, they said that the company has neither seen new NPA formation nor any new resolutions in the first quarter. However, one state utility slipped into stage 2, and resultantly, the provisioning coverage inched up on a sequential basis. We also have a note coming in from Bernstein. They've maintained their outperform call given a target price of 620 per share. They say that it was a disappointing quarter with a decline in the loan book on a sequential basis, but the management has retained their guidance, and the visibility, in their opinion, on reversal of provisions is also improving, and the company's strategy to hedge 100% of its yen borrowing worked out well for them. So overall, we have CLSA as well as Bernstein positive on PFC.
Thank you very much for that. Updates coming in from Bajaj Auto with respect to two new Triumph bike launches in the 400cc segment. The stock is up 2.5%. We'll await more details on that. It's going to be launched ahead of the festive season. Get into a break. We'll come back with more in the markets.
Welcome back. The Reserve Bank of India's Monetary Policy Committee is expected to leave repo rates unchanged at 6.5%, according to a CNBC-TV18 poll across the country's top economists. Ritu Singh is joining in with the findings of this poll and what to expect from the RBI tomorrow.
The big miss on U.S. jobs data, rising expectations of a rate cut from the Federal Reserve next month, the unwinding of yen carry trades, all of these global events are going to weigh on the minds of the MPC members. But as the governor insists, it is domestic cues that are going to guide the RBI. The focus this time around is going to be on inflation commentary, with food inflation reigning at a 6-month high, as well as around the recent regulatory guidelines, specifically on the liquidity coverage ratio, whether there is any rethink at all, the scramble for deposits, the widening credit gap ratio, all of that are going to be focus areas. Now, according to our poll, 100% of the respondents expect no change on rates, given the persistent concerns around inflation on one hand and the continued comfort from growth on the other. The stance of the policy is also widely expected to be left unchanged at withdrawal of accommodation. Now, half the respondents to our poll expect RBI to signal a stance shift only by October, and others even later. Our poll also says that the window for a rate cut may only open by December or maybe even early next year. Now, most of the respondents to our poll said they expect the total quantum of rate cuts in this cycle to be around 50 basis points, with a third even expecting a 75 basis point cut in total. But no change is expected on the average CPI forecast for this fiscal, at least in this policy, with RBI reiterating its commitment to get to that 4% CPI mark. And even the current growth forecast is unlikely likely to be tinkered with. Now, the governor's statement that the markets focus on, that is expected to be more or less even, no big change from last time. So a status quo policy for the 8th consecutive time with a split vote on action. And also keep in mind, this is also going to be the last meeting for the 3 external MPC members whose tenure comes to an end in September.
Ritu, thanks a lot for that. An 8th straight status quo policy is what is anticipated tomorrow. By the way, the markets are off the highs of the day, but the Nifty is holding on with that gains of 1%, currently at around 24,230, still trading with gains of around 250 points, which was the gap up that the GIFT Nifty was also suggesting in the morning. The metals index has staged a rebound in today's session. 2.5% higher is the top sectoral gainer. The broader markets are doing well for themselves. Both the mid-cap and the small-cap index are trading with gains of close to 2% each. The pharma index also trades with gains of 1.5%, as does the real estate index after the CNBC-TV18 news break confirmation. But with that, it's a wrap on this edition of Trading Hour. From Rima, me and the team that put this show together, thank you so much for watching. Halftime Report takes the action forward.